Welcome everybody to our exam 1 review. Just a reminder that your first exam is on the 19th and it will be on chapters 1, 2, and 4. So with that being said, let's get into some accounting. And before we even do any problems, I just want to go over the relationship between the financial statements and kind of what's on the financial statements, just to kind of review. So let's start with the income statement. I'm going to abbreviate it as IS. That looks like a 5. Hold on. Uh, there we go. Well, it still does, whatever. So on the income statement, we know that we're going to have the accounts revenues. I'm going to abbreviate it as R, and expenses. And what do we get when we subtract expenses from our revenues? Net income. So now when we're making our financial statements, the second statement that we're going to make is the statement of retained earnings, which I'm going to abbreviate as RE. Now the equation for the statement of retained earnings, which I've seen a lot of people kind of being confused by, is beginning retained earnings plus net income. So we're already starting to see how the financial statements are like starting to flow together, minus dividends equals ending retained earnings. So like revenues and expenses are also going to affect the statement of retained earnings because they're going to flow into net income, which ultimately flows into the statement of retained earnings. All right, so now our next statement is the balance sheet, and this is the kind of like the statement that everybody should know pretty well for the equation. So it's going to be assets equals liabilities plus shareholders' equity. Now, how the statement of retained earnings ties into the balance sheet is our ending retained earnings balance is going to be on the shareholders' equity. Is it going to be the entire shareholders' equity? No, because we know that shareholders' equity is made up of retained earnings and common stock. And then the last statement that we make is the statement of cash flows. I wouldn't worry about it like making one right now or too much. Just know how it gets affected, which is obviously if there's cash happening in the transaction, then the statement of cash flows is affected. So with that being said, on the exam, definitely know how transactions affect these statements. All right, you know what I'm trying to write. So let's say like we did a service, so our service revenue is going up, and then we don't get cash though, we get a receivable. So we know, so what statements are being affected? Well, we know that revenues are going to be going on the income statement, so we know that the income statement is being affected, and we know that it's going to feed into that income, so the statement of retained earnings is going to be affected. And accounts receivable is an asset, remember, because it's an economic benefit of somebody else going to be paying us something. So that is an asset. So it goes on the balance sheet. But the statement of cash flows isn't affected because there's no cash in this transaction. So keep in mind, just like practice a couple times when you're doing like transactions, just kind of think about how it's affected. Oh, and before we leave this slide, let's talk about the 6 different types of accounts too. So remember, like with our T accounts, this side's a debit, this side's a credit, Washington, D.C. So assets increase with a debit, expenses increase with a debit, and dividends increase with a debit. And on the credit side, revenues increase with a credit, shareholders' equity increases with a credit, and liabilities increase with a credit. And how you remember this: after eating dinner, read stories loudly. And remember that the side that it's on, that's its normal balance, which means that it increases on that side. So that means that an asset is going to increase with a debit, whereas a liability is going to increase with a credit. So if we were going to decrease, let's say, a liability, it would go on this side. It would be a debit. So with that out of the way, let's do our first problem. So how these videos work is I want you to pause the video. I want you to try and do it on your own. And when I mean make a chart, I mean do it like this. So have assets, or let's have cash, I guess. So cash plus other assets equals liabilities plus common stock plus retained earnings. So I want you to pause the video, try out these transactions. Just do like the amounts, and and then if it's decreasing, make the parentheses. So with that being said, I'll let you pause the video and try and do that. Oh, and when you finish this, don't start journalizing right away. Wait to see if you get it right, and then you can start trying to journalize. All right, so receive cash or 50,000 cash from an investor. So obviously we're getting cash. Reading is important in accounting. So we say received 50,000 cash and from an investor, so it's common stock. And as we do these, we should label them as operating, investing, or financing. So a lot of people are going to be quick to label this as an investing activity because of that word investor, but investing activities only deal with long-term assets. So if we like buy or sell land or something like that, or like equipment that's going to last a really long time. So this transaction is actually going to be a financing activity. So purchase $7,000 worth of equipment by signing a note. So we're getting equipment. So we know that equipment is going up, and that's another asset in this scenario. And we are signing a note. So that means it's going to be a note payable or a liability. All right. And now here's the tricky thing. Is it an operating, investing, or financing activity? Well, the correct answer is none, because there's no cash involved. Remember, we label things because that's how they go onto the statement of cash flows. But the statement of cash flows isn't affected if there's nothing in cash. So just keep that in mind. So the next one, purchased $3,000 worth of supplies on account. Now, whenever we see the phrase on account, we always know that there's going to be like a account payable or an account receivable involved. In this case, since we're getting something, we're getting the economic value of the supplies. We know to balance out the accounting equation that it has to be a liability as opposed to account receivable. So it's going to be accounts payable and supplies. So received 8,000 cash for services to be performed later in the year. So again, here we are performing, or no, we're receiving cash for something we haven't done yet. So, but we're still receiving the cash, so it's going to be going here. And as we should know by now that this is going to be unearned revenue because we're getting money for something that we haven't done yet. And this is going to be a operating activity. And the one before it is none again because there's no cash involved. All right, so paid $500 for the month's rent. So paid $500. So we know we're losing cash. And it's going to be rent expense. So retained earnings is going to decrease by 500. And this is going to be an operating activity. Whenever we pay expenses, it's going to be an operating activity. And that includes interest expense on loans. That's another one that people can get confused by when they're like classifying the transactions. So again, interest expense, paying interest, is an operating activity. All right, so the next one. Board of directors declare a $1,500 dividend but don't pay it. So we went over this one in class. As soon as they declare it, they have to decrease retained earnings, and it's just going to be the dividends account. All right, and I'm running out of time, but we know that since they don't pay it yet, but they owe it, we know that this is going to increase liability. It's going to be dividend payable. And I'll finish this up in part 2 of the review video.